Hello and welcome to part 2 of chapter 14's material. This is kind of a blend of another textbook and what you do in chapter 14. So this is a bit of a review of what's happened to the banking sector generally in most countries, most developed countries that is, over the past few decades. So we've had a lot of financial innovation. That really started, and you might laugh at this, but it did start with the ATM, the automatic teller machine, which allowed banks to stay open, basically out of banking hours. If you talk to your grandparents, they'll probably tell you that banks only used to be open certain hours, and that was usually 9:30 to 3:30. Some even closed earlier than that. So some were kind of 10 to 3. And you had to be there if you wanted to take money out between those hours. So that's what people had to do in their lunch breaks. They had to rush off to the bank and do whatever business they needed to do and get back to work. And none of them were open on Saturdays or the weekend. So basically banking was a very kind of limited thing, and you had to basically work it into your schedule. So the ATM kind of opened up all that and meant that banks could offer services where they didn't even have a branch. So not only did the branching rules relax, but also you could have an ATM where you didn't even have a branch. So that meant that the branches were kind of unnecessary in a way, because you could just have the ATM machine and people could do most of their banking there. Also, on the asset side, banks have had quite a change in the sense that borrowers could go elsewhere. There are other avenues open to borrowers now, and once again, if you'd speak to your grandparents, they would probably tell you back certainly before 1970, mid-70s, I would say, the only place you could get a loan was pretty much the bank. So you can see since about mid-1970s, 75 onwards, there's been a gradual innovation in the banking sector. It's been slow but steady, with a few kind of big moves that occurred. So as a source of funds for borrowers, the market share of banks has fallen. Commercial bank share of total financial intermediary assets has fallen. So we've got two effects. First of all, borrowers are going to banks much less frequently. Secondly, banks are much less important even when borrowers do go to a financial institution. Nevertheless, if you look at bank profitability, it's higher than ever. Although they're probably taking a hit right now as we go into the current recession, but pretty much apart from recessionary periods, bank profitability has increased, if anything. Why is that? Well, we discussed that really in a couple of chapters ago, and that's because the off-balance sheet income, things like fees, has relentlessly risen. And you'll know if you have a bank account, 10 years ago you got a decent rate of interest on your checking account. Well, no longer do you get that. In fact, you get the opposite. You get fees on your bank account. For the most part, there's a few banks that don't charge a fee, but they tend to be large and they tend to have other income to offset the fact that they don't charge a fee. But certainly small banks do. So with big banks as well, sometimes they charge a fee. And certainly if you want to do anything other than just regular banking, receive a wire, get a banker's draft, anything, you're going to pay a fee. So here you can see over time, and I think this is why this is good to see this extra material. This is the bank share of total non-financial, so not borrowing between the banks, but borrowing outside of the banks. And you can see the bank share has fallen. It's gone from a height of around, you can see from 1975, it was around 42%. It now has fallen to about 20%. So it's more than halved. So, what's the reason for this? Well, there's a decline in cost advantages in acquiring funds, so the liabilities. Rising inflation led to rising interest rates and disintermediation. By disintermediation, what we mean is that people kind of avoided going to banks because they could get higher interest rates elsewhere. So they went elsewhere. This was a low-cost source of funds, and the checkable deposits that the banks got, they've declined in importance. So that's been one of the problems for them. People are putting their money elsewhere if they can. Decline in the income advantages on uses of funds, so that's the assets. Information technology has decreased the need for banks to finance short-term credit needs or to issue loans. For many of us as well, if you want a loan, you can probably go to some online facility and get a loan there. Same with businesses. Information technology has also lowered transaction costs for other financial institutions, increasing competition. It's often said if you want a car loan, the cheapest place to go is the credit union. Even if you don't have an account with the credit union, you're going to get a better deal than you get with a bank. What's the bank's responses? Well, they've expanded into new and riskier areas of lending. They typically do now commercial real estate loans, much more than they used to do. They also fund corporate takeovers and leverage buyouts, or LBOs as they're often called. And we talked about this already, but they pursue off-balance sheet activities. So anything that they can charge for, non-interest income, for instance, so it's nothing to do with interest, in other words, advice. Sometimes banks will help you with your finances, and they charge a fee for that, certainly for wealthier customers. Concerns about risk. So decline of traditional banking in other industrialized countries as well. That's been the case, I think, pretty much for the whole of the Western world. It's been the case, at least. Decline of traditional banking in other industrialized countries. Oh, well, that's the same thing. Don't know how that happened to be in there twice. So we discussed some of this already. I can kind of skip through it. We talked about the McFadden Act and the restrictions on branching. We talked about the response to those branching restrictions, these bank holding companies. And actually, one thing I didn't mention about ATMs is certainly banks that were in smaller states or had branches that were close to the border with another state. They would actually put ATMs over in that other state because you didn't have to apply for a charter or anything to have an ATM there. So in other words, they could effectively use the ATM to cross into another state. But also it meant that they didn't have to open a branch even in their own state. Here you can see the number of banks, and here you can see the size of the banks. This is interesting because it shows how, it's a couple of years out of date, odd, but it shows you that the majority of banks are kind of small to medium sized. So you can see that 61% are between 100 million and 1 billion. That's not a lot of assets compared to the big guys. The big guys, there are more than 250 billion. And the point is that they have about 50%, those big guys have about 50% of all the assets, even though there are a ton of banks. Majority of the number of banks are, relatively small, between 100 million and a billion. So 250 times smaller. They only have 7% of the assets. So 61.6% of banks, the smaller type, small to medium, have only 7% of the assets. And you can see the total number as of this particular date is 5,856. Now, you're probably saying, ooh, that's a lot. Well, that's come down significantly from where it was. And I'll show you that in a minute. So which are the 10 largest banks in the US? This is obviously a couple of years old as well. But, this is why I keep on going on about JP Morgan, because they are the biggest bank in the US. And JP Morgan was an investment company, by the way, and Chase Manhattan was the retail side. So they merged basically into one bank holding company called JP Morgan Chase and Company. So that's why that's two. And that's, of course, the John Pierpont Morgan that you learned about right at the beginning of the course. That's his legacy. It's still the biggest bank in the US. Bank of America, number 2. Citigroup, that particular bank that I told you about, that withered to just about nothing during the Great Recession. Wells Fargo, which is an interesting bank because it comes out of California. And it was in California until the Great Recession, when it bought out a couple of other banks that had that had branches in on the East Coast and in the middle of the country. And so Wells Fargo has basically expanded quite rapidly from being just California based to a national bank. Incidentally, you're probably thinking, these guys here, they must have branches in every state, right? Wrong. No US bank, not one, has a branch in every single state, in all 50 states. Not one. In fact, I think JP Morgan Chase is the nearest to having in all 50. I think it has something like 42 states or something like that, but there's still 8 states it doesn't cover. By the way, that's astonishing for most countries. So you look at Canada, they have basically 7 banks. That's it. And their 7 banks have branches in all the different provinces. In the UK, there are a limited number of banks, and they have branches all over the UK. In Australia, there are a limited number of banks. By the way, in Australia and Canada and the UK, all the banks are always regulated at a federal level. So I always tell students this: you live in a country that makes its financial sector horribly complicated. Horribly complicated. But as I usually tease my class by saying, you guys must like things complicated in life. That's all I can say. No, it's not true completely, but there you go. So let's have a look at some of the others. US Bancorp. Now, this was a regional bank, and it bought out on the East Coast, and it bought out some other banks, became larger. You can see the assets drop significantly. Can you see from Wells Fargo to US Bancorp? Look at that drop in assets. It's a quarter of the size of Wells Fargo as US Bancorp. And then we just get smaller and smaller. So then Bank of New York Mellon Corporation, that's a New York bank, obviously, originally. That's particularly prevalent in the Northeast. PNC Financial Services Group, I believe they're out of North Carolina. Capital One Financial Corp, their credit card is pretty ubiquitous. You see it all over the place. I'm not sure where they're based. HSBC, North America Holdings. HSBC is Hong Kong Shanghai Banking Corporation. It's based in the UK still. So this is their North America subsidiary. And that's their assets held in the US. They're making quite a big attempt for HSBC to expand into North America, and they've been pretty successful, as you can see. TD Bank US Holding Company, that's TD Bank. They are very prevalent in the Northeast of the US, and they are Canadian, Toronto Dominion Bank. I used to work for them, actually. So that's number 10. So you can see number 9 and number 10 aren't even American. So of the big boys, you can see there are really only 4 big boys in terms of banks in the US. JP Morgan, Bank of America, Citigroup, and Wells Fargo. Then you're getting into what we call the super regionals. So regional banks that have kind of expanded a little bit. but they're basically still regional bank, not state, but regional. So they're in various states in that particular region. And then you've got the foreign big boys come in, so HSBC and TD, and trying to expand their foothold, their footprint, I should say, in North America. That means, if you think about it, the vast majority of banks are a lot smaller than those guys in the US, and indeed they are. So the number of banks has declined dramatically over the last 30 years. Why? Well, because each recession that comes and goes, you've got banks that fail. When a bank fails, typically what the FDIC does, as we discussed earlier, is the purchase and assumption strategy, and that is to get another bank to take over the smaller bank. And it usually is a medium-sized bank taking over, small to medium taking over a small bank. So there's been a lot of consolidation in the banking sector. Deregulation, Regal-Neal Interstate Banking and the Branching Efficiency Act of 1994. This allowed all banks in any state to open branches and to do business in any other state, except for Texas. Texas decided to opt out of this particular act, and that was agreed by the Department of Commerce that they could. And the reason why is that Texas had such a terrible time during the S&L crisis. Next, economies of scale and scope from information technology. One of the things I noticed banking with American Bank is they had quite a struggle basically getting the right IT set up for them. And even now, I have problems occasionally with them. With the big guys, usually they have a whole IT department doing this. What the smaller guys do, like American Bank and Corpus, is they farm out that kind of IT work. But that's the problem, is when things fail, they've got to get their, the company that they've farmed out this IT stuff to, web banking, etc., to sort things out. Now, there are some good companies that do this. I'm not saying that they aren't good, but the thing about the big boys, the large banks, is that they can get the economies of scale and scope to do that in-house, and often to bring about innovations that the smaller guys just can't afford to do. So the result of all this consolidation is not only a smaller number of banks, but a shift in assets to much larger banks. So we should see the asset concentration begin to shift to the even more to the bigger banks. And here you can see the numbers. So the numbers are, really quite shocking. So we've gone from 14,000 just in 1985, which I know is a long time ago, but just in 1985, we had 14,000 banks in the US. 14,000. And it's now, as you know from the previous slide, less than, just over 5,000 basically by now. I don't know how much it is now, but since that was 2017, wasn't it? So you're probably looking at just over 5,000. So nearly a third of the number that existed in 85. So 2/3 of the banks that were there in 1985 no longer exist. Now, probably you think, wow, that's a big consolidation, and wow, the US, gosh, do we really want to consolidate any further? Well, I think the foreign perspective on this is kind of quite good because, when I think about it, Canada has, as I said, basically 7 banks of any size. And there aren't really small banks in Canada. It's the big boys, and that's pretty much it. So there's 7 banks. Now, Canada is about 1/10 the size of the US. So if the US had roughly the same number of banks, that Canada have, but scaled up 10 times bigger. We would have 70 banks, but we don't have 70. We have just less than 100 times that. So you can see how crazy the US banking system is in a way. So what will the structure of the US banking industry look like in the future? Well, although the United States retains a unique banking structure, I told you about that already, it is unique in possessing a large number of banks. Its structure is converging with systems in Europe and Japan. And I could agree with that statement, but probably the operative word, and should be in there, is slowly converging. It takes time, and to be honest, during recessions you get a much bigger shakeout happening. So how far the convergence between banking systems will extend is the subject of ongoing academic debate. And, are these things good? So what are the benefits of all this consolidation? Well, it's kind of ironic when you think about the perfect competition model. It has tons of different firms, and I guess the regulators always thought that more banks is better. There's more competition. But that's not necessarily so, because these banks were only in competition with a small number of banks in the same state. So they couldn't really achieve economies of scale because they couldn't expand outside their state, and we're still living with the legacy of that, given how many banks we do have. So I think that as we go to a smaller number of banks, in fact, things could become a lot more efficient, and that will drive out competition. It'll drive out the small banks, and that'll increase the competition. Not drive out, but drive up the competition, I should say. Because, in many places, you think about it this way. In many places, I remember when I lived in Middlebury, Vermont, I looked at the choices for where to bank. I'd never heard of the names of any of these banks. So I just went with the same bank that the college in Middlebury where I worked, that they used. But anytime I went away from Vermont, I had I didn't have problems, but I couldn't find a branch of the bank that I branched with. Oh, no way. I mean, they only existed in a small part of Vermont. So that can become a problem. So, having greater competition means that you get banks from other states coming in and being competitive there. So you get the increased economies of scale and scope. Scale meaning they can get a lower average cost of doing things because they do so many of them. And economies of scope means that they do a bigger range of activities, a bigger range of services can be offered to the client because it makes it worthwhile because you have more clients. There's a lower probability of bank failure from the more diversified portfolios. If you're a small state bank, then you're dependent on the industry in that particular state. And in some states in the US, that's pretty limited, farming and maybe a few other bits and bobs, but hardly representative of the US economy as a whole. What's the downside? There's always benefits and costs, and the costs, I think, are pretty obvious. Those small banks offered a very personalized service. And, I remember I knew all the people who worked in that bank in Middlebury. I knew them by name. They would do extra things for me. If they were just about to close the doors and they saw me coming, they might just open it up to let me in, because they knew me and they knew my business. They knew everything. Mind you, they knew everything that was going on in the village as well. But that's another matter. So, in terms of getting a loan as well from one of these smaller banks, they're much more likely to embrace the smaller businesses that operate in those smaller towns as well. And small banks, are much more likely to because they've got the same personnel likely, to be able to forge a better relationship generally with the businesses that they serve, rather than a big bank where the personnel are going to change pretty much all the time, etc., etc. Another cost is banks expanding into new areas may take increased risks and fail. So one of the costs of the consolidation is that some of these smaller banks in the will to survive, may expand into these new areas and thus not do well and fail that way. So that's one of the problems because of that increased competition. Okay, this basically covers what we've talked about before in terms of some of the history of the change in the regulatory structure in the US. And here we talk about the erosion of Glass-Steagall. If you remember, Glass-Steagall was 1933, and this explains how Glass-Steagall was chipped away at, and with eventually a hearing at the US Supreme Court, 1988, that validated the Fed's actions, approving commercial banks underwriting securities. And then we got this 1999 Graham-Leach-Bliley Financial Services Modernization Act, which kind of put into law some of the things that the Fed had allowed to happen. Under this particular act, it wasn't covered really in detail in the slides for the book. So here it is. What happens is that Graham-Leach-Bliley abolishes Glass-Steagall. So Glass-Steagall is no more as of 1999. The states regulate the insurance activities. The SEC keeps oversight of securities activities. Office of the Controller of the Currency, that's the federal level, regulates bank subsidiaries engaged in security underwriting. Federal Reserve oversees the bank holding companies and the stimulated consolidation of the banking industry. In other words, fewer banks. So you can see what really happened under Graham-Leach-Bliley is you got rid of Glass-Steagall, but the organization of how these bank holding companies would be regulated was done under this particular act. Now, the other good thing that's done here in this chapter towards the end is a comparison with the rest of the world. It's interesting because most of the banks in the rest of the world, the developed world that is anyway, do not have any separation at all between banking and securities industries. Remember, we do still, but they can be under an umbrella, which is the bank holding company. But, for instance, in Germany, Holland, and Switzerland, there's no separation. In fact, in Germany, Holland, and Switzerland, they have what are called universal banks. Now, universal banks can offer any financial service. So if you go into a bank in Germany, you can get pension advice, you can buy mutual funds, you can buy stocks, you can buy auto insurance, you can buy home insurance, you can open an account, you can buy a CD, etc., etc. They can offer any financial services that they want. So, in Germany, Holland, and Switzerland, their banks are much more kind of less specialized than our banks. They're much broader in terms of the services that they can be provided to the general public. In the UK, we have a slightly different setup. Banks are called, it's called universal banking still in Great Britain. Banks may engage in security underwriting, but they have separate legal subsidiaries for things like trading and other things. So bank equity holdings of commercial firms are less common. Oh yeah, in certain countries, by the way, Germany, for example, banks can actually own companies as well, because they can own shares, they can buy up companies. I'm not just talking about financial companies. They can do anything they want, really. So when a few combinations of banking and insurance firms. Usually in the UK, the insurance firms are separate from banks, and there's some really big, powerful insurance companies in the UK. So the banks and the investment banks are really can be thought of as pretty similar. You know, Barclays is a good example of a company that has a corporate banking side. In other words, that's like an investment bank, and a retail banking side, like has branches, etc. So that's a good example of that in the UK. Japanese style system. Their system is really different to that as well. It takes the universal banking system even one step further. What it does is it says that banks can be part of industrial conglomerates. So at one point in my experience in the private sector, I worked for Mitsubishi Bank. Now, you all know Mitsubishi is a maker of cars, but Mitsubishi is a keiretsu, and a keiretsu is an industrial conglomerate in Japan. And that means that Mitsubishi makes tanks, cars, stereo systems, and also, you know, has a bank. So the bank's basic function is usually, you know, the usual banking function, but also it provides financing for all the other parts of the keiretsu. So these huge industrial conglomerates are kind of interesting because they take that universal banking idea one step further and allow the actual bank to become part of some larger industrial conglomerate. Actually, you know, the one surprising thing is that Sony, you'd expect Sony, being an industrial conglomerate as well, to have a bank, but they don't. You know, there you go. I think the Mitsubishi is the best example, though, of a keiretsu that's heavily combined with a bank, a large bank as well, in Japan. And that's the end of this chapter. I hope you enjoyed it. And it's the end of the course for this semester. So thank you for listening.